Okay, so we are 3 minutes away from the virtual real estate investing meetup. We have special guest Jacob Perez. Jacob was an excellent guest on Purchase to Profits a couple of weeks ago, and we will be talking about joint ventures and partnerships. So if you are new to real estate investing, or if you are already investing in real estate and want to learn how to scale your business using joint ventures and partnerships, we want you to join us and participate. You can click on the link right above this video to join us with all the other guests. After Jacob and I talk about joint ventures and partnerships in real estate investing, we'll be having a Q&A where you can ask any question you want about real estate investing. So if you are brand new to real estate investing, or even just starting to consider it, or if you have a couple properties, or if you have a sizable portfolio, we want to hear your questions because we can all learn from each other. And the great thing about a virtual real estate meetup is we can talk with people many states away, many provinces away, so we can get some really good tips from people in different markets. And like I said, virtual meetup, we can talk with tons of people all around the US and Canada, and maybe even overseas. We'll see if we have anybody internationally join us today. And following the Q&A, everybody will be able to share their real estate goals, their challenges, any issues they're having right now. And most important of all, we will be having accountability. So we will all be setting goals that we want to accomplish before the next meetup, because whatever gets measured, we usually end up having success with it. And after talking with about 100 successful real estate investors, I've learned that having the end goal in mind is so important when structuring your real estate portfolio. So we will be going live, or we will be getting started in about 1 minute. And I'm really looking forward to learning from all the guests we have on, and especially our special guest to kick things off, Jacob Perez, who will be talking about joint ventures and partnerships in real estate investing. So if you're watching this right now and you're not on the meetup, click the link and get registered, because I want to learn about what you're looking to do with real estate investing. So we just hit 7 o'clock. We are now live with Jacob Perez. Jacob, thanks for joining us today.
No problem. Thanks for having me.
Yeah, I really enjoyed our chat that we had when you were on the show, Purchase to Profits. And you talked a lot about how you're using partnerships and joint ventures to build your real estate portfolio. So I thought you would be a perfect guy to have on and share that knowledge with everybody on here.
Yeah, I think these joint ventures just seem to be the hot topic always in real estate. You know, we've been doing a lot of investment seminars just out of our brokerage, teaching either realtor partners or clients. And one of the feedback we got was everyone's like, you know, we want more on joint ventures, right? So I think, you know, when it comes to real estate, you know, a lot of people hit a wall, and they hit a wall at a lot of different phases in their portfolio. And joint venture is typically like the answer to break through that barrier almost every single time. So, you know, people who haven't done joint ventures want to learn about them. People who have done them want to know how they can scale it further. So it's definitely a topic I don't think that's going away anytime soon in real estate.
Oh, for sure. I know myself, I've experienced that capital crunch. You know, everybody runs out at capital at some point, and it's how you can source that capital to continue to grow your portfolio. So to kick things off, do you want to explain what we mean when we're talking about joint ventures or partnerships to somebody maybe who's never encountered that term before?
Yeah, absolutely. So joint venture, it's just a cool way of saying it's a partnership. So that's really all it is. Doing a joint venture real estate transaction means two or more parties have come together to purchase property, invest in real estate. And the great thing about joint ventures is, you know, there's all different types of ways that you can structure them. So you could have someone who has expertise as an investor. Maybe they have a skilled trade under their belt. Maybe they have capital. Maybe they have time, whatever it is. If you bring something to the table, you might be able to find someone you could partner up with and help you purchase a property or purchase many properties that maybe you wouldn't be able to do by yourself. So I always take it back to the basic joint venture structure that I try to follow. And that's, you typically have a managing partner in the transaction, somebody who sources the property, knows what it's going to rent for, knows what the renovation costs for me, knows how to source a mortgage, who's going to interview the tenants, do all the bookkeeping for the property, handle all the maintenance requests. That partner typically has a 50% ownership of the property. Then you have a capital partner who typically will invest the down payment, 20% down in most cases, and finance the property in either their name, owner in a company, whatever makes the most sense. And that partner is typically hands off. So in my kind of transaction, the investment partner invests the capital. That capital is always theirs in the event that we sell. And then any profits or expenses that we incur throughout the transaction, we split 50-50.
Gotcha. And I think you made a really good point in saying, and just saying like you have that capital partner and then you have the managing partner, because you want two people in the deal with different strengths, right?
Yeah, no, absolutely. I think a lot of people, they will partner up just because they feel as if partnering up mitigates the risk somehow. But both partners have the same value that they bring to the table. Maybe, you have two young guys who both don't know a lot about real estate investing and they just choose to go together. Now, maybe the two of you combined, your purchasing power is a lot higher. So that makes some sense. But, if the issue is that maybe you lack the expertise and then you're bringing in a partner who also lacks expertise, but you just you'll figure it out together. To me, I think you're better off just going solo in that type of situation, because if you go solo, you'll learn everything. And then theoretically, you'll have more to bring to the table when you want to source a better fit in a joint venture partner later.
Yeah. And I would imagine most of the people on the meetup right now, they're interested in being that managing partner. They want to be the person with the sleeves rolled up, finding the deals, sourcing the deals, and doing all the negotiating. So what sort of tips can you give them in finding that money partner to come in and partner with them?
Yeah, I think there's a lot of different tips, and you'll talk to a lot of different people who say a lot of different things, right? You'll have a lot of people who preach, hey, invest in your first real estate deal with zero money down, right? Bring in a joint venture partner, do this, do that. I'm not really of that philosophy. I think you really got to do it yourself first. So if that requires you getting a real job and then saving up your own money and purchasing a property, I think that's the best way to go. Because even for me, for example, let's say I was somebody who had capital, didn't have real estate expertise, and I wanted to invest money in a deal. I wouldn't want to invest it with somebody who doesn't have a reputable job, who hasn't been able to save up their own money. Because that to me shows a lack of success in many areas of your life. So how's that going to translate to real estate, right? So my best advice would be do your own real estate deals. If you can show success in your own portfolio, that's a really, really good way to ease an investor's risk appetite, because they'll see that you're doing it yourself right now. And then you can pull on real life examples as opposed to, projections that you heard from somebody else or something like that.
Yeah, that's a really good point, because what I find is lots of people getting into that partnership joint venture area, they always say, hey, Seth, why aren't people giving me money? Well, you have to put yourselves in the investor's shoes and picture yourself as the guy with the or guy or girl with the capital being approached by a general partner. Nobody would want to give their money to somebody who just comes out of the blue and says, hey, listen, I have this great deal. We want to get to know them, know what their strategies are, know what their values are, what are they looking to accomplish. So would you say, what sort of plan, or would somebody need an action plan or a book to kind of help talk with the money partner?
Yeah, I think there's a number of different things you might need, right? I think, there's an action plan to maybe getting your first property, right? And that might require networking, saving up a down payment, purchasing a property, and just taking a leap of faith, right? In terms of books, things like that, I think, Real Estate Joint Ventures in Canada by Don R. Campbell, it's a great book that really summarizes everything there. Another really, really good book for Canadians is Money, People, Deal, Stefan Arnio. He breaks down a lot of different joint venture criteria that you might not have thought of, and also ways, as someone who's actively doing joint ventures, how to make it more strategic as you go. I really like that book.
Yeah.
I would say mainly you shouldn't be so focused on getting the joint ventures. You should be so focused on getting your first deal and having success with it. And then that will be the thing that you leverage in order to get the partners, right? I think reading a lot of personal development, being respected in your circles, that stuff's going to really matter, because if you get a joint venture partner, it's likely to come from your inner circle, whether it's friends, family, family friends, something like that. It's likely where your first partner is going to come from. So make sure that, you're carrying yourself in a certain way that commands some type of respect. You're reading books, self-education, all that kind of stuff. I think, fighting to do your first deal and then just making sure you carry a respectable reputation with yourself. I think those things will take you much further than maybe learning the criteria or the legal structure of a deal.
For sure. And what you said about getting your first deal done is so important because that gives you that track record, and everybody learns so much. The learning curve is so steep in that first deal. What I found myself is when people start asking me questions about joint ventures and partnerships, they're usually a couple deals along and they've kind of hit that capital crunch. So they have a bit of a track record, but now they have to kind of change their mindset to a money raising mindset that they might not have had to do when they were just busy sourcing their own deals. So maybe can you talk about how that shift in turning into a money raiser can start?
Yeah, so I think that we talked about this on the podcast. It was kind of a funny point, and it was, a lot of people when they do real estate by themselves, they kind of keep it quiet. They don't want to brag, things like that. And then when you go into money raising mode, you really got to show people what you're doing. So you got to be getting in a lot of real estate conversations. You should be encouraging other people to buy real estate for themselves. If you're encouraging them to buy it for themselves, they're going to start to put the wheels in motion, ask you about how you make money in real estate, what type of deals you like. And then a lot of those people who have interest are potential joint venture money partners, right? Because there's a lot of people who want to buy real estate, but we know there's tons of people who will never take the leap by themselves, right? So if you can kind of stimulate someone's interest in real estate, you can show them how you're having success in real estate. And then let's say you do that with 10 people, maybe 5 of those 10 are never going to do it themselves. And maybe 2 of those 5 might be a potential real estate partner. So I think that's what you want to look for. And again, it's a lot of conversations about real estate, encouraging people to get involved in real estate, not necessarily with you, just encouraging them to do it. And then you'll see some opportunities naturally form from there.
Yeah. And what I find with lots of money partners is they're very successful at the jobs and careers that they've chosen. So let's say they're a dentist. Dentists and doctors work long, crazy hours. They are experts in their field, but they still see the benefits of investing in real estate, but they just don't have the time or the knowledge. So they're looking for somebody with that expertise, that real hands-on experience in real estate to partner up with.
Exactly. Right. And that's why, sometimes you might be at a job that you feel like doesn't stimulate you, or it's kind of 9 to 5 checking in, checking out. But often those are great jobs to be in to keep you really, really hungry in real estate. Like you mentioned, those joint venture partners, a lot of them are self-employed people. They have their own businesses. For those people, it's hard to make a mental shift to, you know what, I'm going to take up something completely new. That's not going to pay me for a long time. That's going to require me to go to other cities, take out my time outside of work, where they can just look at their business and see, a clear way to bring in a couple new revenue streams that's going to directly impact them right now. So that's why those self-employed people are great partners. And like I said, if you're in one of those jobs where maybe, you're not 100% engaged in your position, embrace that, because I promise you'll probably be in a position at some point where you are, and it's going to take away from your investing. Kind of like what I'm focusing on right now.
Yeah, for sure. And one of the questions I usually get is about splits. And this is something I feel very strongly about, because I truly believe that the managing partner in that relationship brings a lot of value to that partnership. Do you want to explain how things are usually split up, and then maybe we'll go into some detail?
Yeah. So as we kind of alluded to earlier, we got a little bit more clear with it, right? So you have the investment partner who's putting down the capital and financing the mortgage. They're typically putting 20% down. And then after that, any principal pay down on the property that you purchase is split 50-50. Any cash flow that you make on the property is split 50-50. Any appreciation when you sell is split 50-50. And any expenses that come about is also split 50-50, right? So I think for someone who's only purchased maybe a primary residence 5% down, or maybe somebody who, was gifted 20% down for their first purchase, they don't have the concept of, how does somebody save up 20%? And then what they also think is, that's a monumental amount of money. Okay. Yep. But realistically, the way I always look at it is, you could look at the returns you're going to make for that partner, and that easily justifies it. But I would just say, is this ever going to happen if this doesn't happen with you? So for somebody who has 20% down, but they don't have the time, will it ever happen without a managing partner? It'll probably never happen without them. And the fact that they always keep their capital because it's returned to them in the event that they sell, it's essentially a win-win. As the partner, you only make money if the investment makes money. So you could look at it as, how do I get 50% of this deal for financing nothing? But really, I look at it as, I'm doing all this work and I only get paid when we make some money off this. Like, I'm at the point now where like my psyche is completely changed on it, where I'm thinking that I deserve a fee just for going out and looking for the properties.
Yeah.
I believe maybe I deserve like a $3,000 to $5,000 fee up front just to look for them, right? So, there's a lot of, you can't buy experience, right? So, you can't just pay anybody to be the managing partner because they needed the years, the experience, their own personal risk that they took in their own property. So, being a management partner, being in a position to do that, I think you bring a ton of value to the table. And the more deals you do, you'll really notice it. That's for sure.
Yeah, and you touched on a really important point, which is the alignment of interest. Like you said, that managing partner won't make a profit unless the project succeeds. And whether you're doing a larger syndication or a partnership, you always want to look for those types of arrangements where it's really both parties are always aiming towards the same result.
Yeah, exactly. I think, we talked about it on the podcast as well. It's just joint ventures are the ultimate win-win. And, your partners will see the value when you start making the money and they'll immediately want to reinvest with you. So yeah, I think once you get over kind of your first successful partnership, that idea of, showing your value or being able to communicate that you deserve that percentage or that cut, at that point, I really feel like, that conversation is just going to be a thing of the past. And like I mentioned in that Stefan Arnaud book, Money People Deal, Stefan even talks about how, the first person, your first joint venture partner, maybe they get, for example, a 50-50 split. But if they refer you another partner, they get potentially 5% of the cut in the next deal. And that new partner who invests with you when you're not as risky because someone else has already taken the chance gets 45, right? Yep. He talks about different ways to slice the pie that I think are really interesting. But yeah, I think, the more real estate you do, the more transaction, whether it's personal or with a partner, the more you'll understand the value you bring, and you'll bring more value deal because you'll have learned so much.
Yeah, no, I absolutely. What would you say? Because I get this a lot. Somebody's found a money partner bringing in the most of the down payment, but then they'll come to me. It's their first time doing it, and they'll say, "Seth, this person's bringing in 50% of the down payment. I'll bring the other 50%, but then, we'll split everything 50-50. To me, that seems like it's too much because that money partner is bringing only in half the capital. The managing partner is bringing in the other 50%, and they're still giving away so much, but because they don't value the experience and the time necessary that they're bringing into the equation. What would you tell those people?
So I would say there's a couple pieces to that, right? On paper, is that a good arrangement? No, right? On paper, You're doing too much for what you're putting in because realistically, what you're doing is you're just giving somebody 50% equity for being a banker. At that point, you might as well bring in a private lender, something like that, to finance the deal for you. Now, that could still make sense, that arrangement. So for example, let's say your partner is a first-time home buyer and you can position this as a primary residence and you're putting 50% of a 5% down payment. So you're putting 2.5 in and it's a good deal. I'd go forward and do that deal. Maybe if you pay yourself a cash flow, a management fee out of the cash flow, maybe that starts to make sense for you, right? Another way to look at it is this is just such a great deal. This is my only opportunity to close on this deal. Maybe it's worth it in that position as well. So I think, there's a lot of different factors when it comes to that. I think you just got to assess the deal piece by piece. But again, like we mentioned, joint ventures, you can structure things differently. If you're not going to give yourself anything extra and, the deal's not spectacular, et cetera, then maybe that doesn't make sense. But, if that's your situation, maybe you can work it out where, both people win.
Yeah. And before we get to the Q&A, what advice would you give people in terms of the partnership agreements? Like what sort of things should they look out for when they're doing those?
Well, I think it starts before the partnership agreements. It starts with who you're partnering with. So you want to make sure that you're partnering with someone you trust, but also, you might trust somebody, but they might not fit the criteria. So you got to think, what does this person expect out of the investment? How quick are they going to want to return on the money? Do they have unforeseen expected costs coming up? Do they have a rocky relationship with their husband or wife where divorce might be coming up? Do they have a wedding coming up? Maybe that's a big expense, right? They're the kids going to university. There's a lot of things that will be coming up that they might need money for. They might want to exit soon for. So I think it's vetting the correct partner first, right? But I think after that, when it comes to setting up a joint venture agreement, you want to thoroughly vet a legal paperwork with your partner before an offer is even going in. And then I would say as well is there's different ways where you can protect yourself. The good thing about being the managing partner is you're controlling the whole asset. So realistically, is a money partner going to be able to go and sell the property behind your back, something like that? Like, probably not. They probably don't even know. They probably don't have keys to the house to show it to a realtor, right? Yeah. So it's like that kind of stuff, it's not really too concerning, but I would say just make sure you properly vet your paperwork with a lawyer in advance. And then I would say, if you really want to take it one step further, after you're done your renovation, all that kind of stuff, you could register lien against the property with your ownership as well. That way, if anything goes south, you'll always get paid.
Yeah. And I know there's been a couple situations with other investors I know quite well where, they're in, let's say, year 3 of a 5-year hold, and the money partner says, hey, listen, I need my cash out for whatever reason. But that partnership agreement very clearly stipulates what has to happen. So the managing partner was saved in that case by having a very clear agreement that they did right at the start.
Yeah. So, a lot of people like to do that is schedule exits throughout the joint venture, right? So in year 5, managing partner, capital partner has the opportunity, the right to exit type thing, yeah. Right? I would say with that kind of stuff, again, it's about the partners, right? And vetting the correct partner. Obviously things can change, people can change, all that kind of stuff, but it's vetting the correct partner. I have some joint ventures where it's with extended family. If any of us wanted to exit, we would likely exit. But again, that just tells you that, okay, you got to buy properties where you can force the value right away and get what you need out of it on day one. If you're buying something where just banking on appreciation, new construction, something like that, well, yeah, those are just going to be risky on their own, let alone with the joint venture partner. But I think, like when it comes to scheduling your exits, I'm a big believer of that stuff might all go by the wayside, and you as the managing partner might be the reason why. Like, you don't know what's going to come up in your life. So I think that, just having a partner where you guys are going to be able to work with each other when that stuff does come up is most important.
Oh, for sure. And, as a managing partner, you're the one with the real estate experience. So you really should be the one choosing when to exit that property, because you'll likely have that handle on where we're at in the market cycle, what all comparable properties are doing. The capital partner really shouldn't be making those calls because they don't have the expertise.
Yeah, they should be chilling out. They shouldn't be stressed. They should be, picking up their bookkeeping at the end of the year, handing it over to their accountant, collecting the check, whatever it is. And again, it comes down to getting the right partners. It's tough, right? Because you might be in a position where you just want any partner, right? But, if you just met somebody at a seminar yesterday and you're talking about partnering up with them, I don't think that makes a lot of sense. If, like we talked about earlier, you're jumping in with a partner who you're both inexperienced and you're just going in 50-50. I don't like that structure at all. And the thing with having partners too is, it slows you down. So it speeds you up because you can do more deals, but in a way it slows you down when it comes to decision making. So you just want to make sure that, if you can do things alone, I think that is the best route to do it. But when it comes to partnerships, just making sure you're a little bit careful with who you're working with, because I promise you, if you do a couple successfully, you get one good joint venture partner, more will come pretty quickly.
No, for sure. So we're going to head into the Q&A. So I'll stop the live stream here, and then we'll chat with everybody about what they want to accomplish.